This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
We're just around a table here in New York. Binky Chadha, Chief Global Strategist and Head of Asset Allocation over at Deutsche Bank. Morning, Binky.
Good morning, John.
I love a title in Southside Research, The Wobble. Can we talk about the wobble? What is the wobble in this equity market? What is that?
The wobble is that, we are basically overdue for a 3 to 5% pullback. It would be normal. And believe it or not, we are now running in 95th percentile plus in terms of the duration, even though it seems rather short since March, since we had a 3 to 5% pullback. As I said, that's pretty normal. 3 to 5% pullbacks happen every 2 to 3 months. So it's getting a bit extended, number one. Number two, as you know, the rise in positioning this time around has been, pretty vertical, especially on the discretionary investor side. And so it's an additional reason, really, for looking for, when that process is over. So I'm not being normative about this
Right.
as to what should happen. But, if and when that does happen, we'll tell you that part sort of played out.
What is the Chadha process to buy on the dip? I'm fascinated. You're sitting there like Ace Greenberg years ago at Bear Stearns. You got buy tickets over here, sell tickets over here. What's the Chadha process to buy in the dip?
To buy on the dip, you have to have a view on what's the catalyst for a correction.
You got to reframe your view 3 years out.
Not 3 years out, but what's driving a pullback. So the kind of pullback I'm talking about is really more sort of a consolidation, and sort of you want to see positioning rise gradually rather than vertically, as it sort of did starting in late May.
Does it make you nervous that everyone on Wall Street, all of your colleagues, are revising upward their expectations for the S&P?
It doesn't make me nervous. It's probably a little bit overdue, is the way I would put it.
You're like, welcome.
We are just reporting basically, the second quarter of pretty solid sequential growth in earnings. So if this was GDP we were talking about, and you were getting strong growth 2 quarters in a row, I think it would have an impact. The equity market tends to look at things on a year-on-year basis, so that makes the turning points very fuzzy to be able to tell. If you look at headline earnings growth year-on-year, yes, we are still running negative, but a lot of that just simply has to do with the oil prices from last year. You take energy earnings out, and it's first quarter of positive growth year on year after 4 negative quarters. I think it's more important to look at earnings growth on a sequential basis. And also on an underlying basis. And really, if you look at underlying earnings, which is taking out energy, taking out the financials loan loss provisions, we've had 2 quarters now of 4% plus growth.
Yeah.
And we only fell 6.5% last year. So actually underlying earnings are at a new high. And, the narrative is about a recession.
Well, some people are also pointing to small business optimism, which came out this morning earlier, the highest levels in 8 months, right? So sort of edifying your view. How much do yields push against that? We were talking about what's more important for your equity call this week. Is it going to be CPI on Thursday, or is it going to be the Treasury auctions, and how many people step up to buy them?
Yeah, I think yields matter, but it's really been much more over the last 18 months. It's really been much more about the volatility of the message coming out of the rates market rather than the level of rates. So as long as we are talking about, 25 basis points here and there, yeah, this doesn't really impact my view. If we get a big acceleration in inflation and a big, response from the Fed and uncertainty increases, then, it's a bigger concern and a bigger pullback, I would say.
How many of these growth stocks are actually growth stocks anymore? I'm looking at their multiples, and they've got pretty tidy growth multiples on them, but how many are actually delivering growth?
So, I would say, the focus shifts over the course of the cycle. What we've basically seen is, the mega cap growth in tech stocks, their earnings turned around first and very strongly in the first quarter. And it was pretty V-shaped move if you're looking quarter by quarter. And that's now sort of widening out is the way I would put it. So, where's the growth? Trade. So first tech caught up with everyone else who hadn't fallen by as much. And the two have really, since late May, mega cap growth in tech and the rest of the S&P 500, they've moved really in tandem. But it does mean that since mega cap growth in tech earnings, since end of May is a very short period, but their earnings do grow faster. So actually on a relative multiple basis, the relative valuation is coming in.
You might be annoyed with me for bringing up a single name, but I think everyone's fascinated by the move with Apple at the moment. Down for 5 straight days into today. Yes, they're trying to snap back this morning and bounce, but ultimately, are they producing the growth? Can we have the biggest weighting on the S&P 500, the biggest weighting on the NASDAQ 100, traded a multiple of something like 30 times forward earnings when it's not delivering any growth?
So, I mean, as you know, I don't comment on individual
I'm just
stocks.
wondering, from a valuation perspective, what the signal is that you take away from that name at the moment and the way it's performed.
Sure, but I think that's part of the process, of sort of the rally that we've seen so far broadening out. It's precisely that question that broadens the rally out because, if we are the market's running with the soft landing narrative. And if the soft landing is going to happen, then you're going to have cyclical growth. And so you should be rotating. And the market has, it's sort of sitting in the middle now. I mean, we're moving in tandem, as I said, after, growth stocks just leading the charge. And at some point, I would expect, the next phase.
Okay, so you got a wobble. The Chadha wobble is in place. Does that mean you reset your SPX outlook?
Oh, no.
Did we get to 5,000 this morning on pullback?
I think that, it's important to keep in mind that we haven't fulfilled even the 3% correct, pullback yet. So we were down basically
we're cratering.
I think, a return of normality after this big repricing that we've had, would be helpful.
Well, just for our listeners and viewers, John, I mean, can we get Chadha to go to 5,000 today with the wobble?
Not today, but yes, It is our soft landing target. Yeah.
Binky, thank you for clarifying. Binky Chadha there.
Pleasure.
At Deutsche Bank. It's good to see you.
We're going to get a brief on these markets right now, and I love what she says about August and summer. Meera Pandit with us, global market strategist, JPMorgan Asset Management. You'd said, Tom, you're jogging in place. You sound like the entire Keene family, because that's what I do. I jog in place. What does jogging in place mean for a market that's been a moonshot since October?
When we think about the market and the risks here going forward, there's not a whole lot of upside risk here, but I think that the downside risk is somewhat limited. Because if we think about where we are with the markets, we are in between the inflation spikes and the Fed hikes, but also waiting for the economy and profits to sour. So I don't know that there is a whole lot of upside catalyst in a world where profits are just better than feared. We need to see some more out of the profits landscape in order to get some more upside from stocks that have already rallied really hard and that have already experienced some pretty high valuations. But at the same time, until we see some more souring in profits in the economy, I think we're in an environment where stocks are essentially jogging in place where we are today. Right. And that's not just for stocks. I think it's similar for yields. The pop in yields we've seen more recently, I would attribute that mostly to the pop in growth. Yes, there was a Fitch downgrade. Yes, we're seeing some inflation break-evens move a bit higher. But really, it's all about growth if we think about this higher yield environment since the May FOMC meeting. So if we consider that environment, I think that yields, too, for the rest of the year could kind of jog in place until next year.
Your charm at JPMorgan, this is English major out of Tufts CFA, which I think is the coolest thing going. I can't imagine what the CFA was like for you coming out of that wonderful background. You write the documents at JPMorgan. You actually craft the documents that you're putting out. What are you writing right now about 60/40?
Right now, if we think about the 60-40, it's had a huge rebound over the course of this year. Last year, the 60-40 was dead, but I think what's important to think about with diversification is that markets and the economy look in opposite directions. Markets are very much forward-looking. The economy is at best looking at where we are today, but also looking backward at the data we've already seen. And if we look at periods in history where the 60-40 has struggled, take 2008, take 1974. If you look at the next year, 1975, if we look at 2009, those were by no means good economic years, but you did see the markets rebound. I mean, 2009 is a great example where you see markets bottom in March. We start to get out of recession in the summer, and actually the unemployment rate continues to rise until October. I think that's a helpful guidepost for where we are today, in that the market has priced in a whole lot of bad news and a lot of risks and threats, and we have yet to see all of them crystallize, but the market is already sort of looking a little bit beyond there. And that's a good environment for diversification.
What do you say to a client who theoretically comes up to you and says, hold on, this time is different. Inflation's going to accelerate. These bonds are going to be worthless. It's going to wreck our valuation of the stocks, of the stock holdings that you currently have. We're focused on something that's really problematic. We want to just hide in cash. I don't see how you could be calling for yields to go back down to something that was normal. What do you say to them?
Ultimately, if we look at cash right now, clients love a guarantee. If you can get a guaranteed 5% in a CD, that seems great. But the reality is, if you think about something like a 6-month CD, you have some reinvestment risk there when we think about the arc of the year. And with yields where they are now, with above trend growth, well above trend growth, really for 4 quarters in a row, if we even start to see slightly sub-trend growth, you're going to start to see yields come down. If we see inflation soften a little bit more, you're going to see yields come down. Doesn't mean they need to crater this year. And again, they could be jogging in place a bit. But as we head into next year and we look at that 12-month outlook, yields can start to come down. So when you sit in cash, you have this opportunity cost where your income can potentially come down, but also you don't get the benefit of the upside. Within stepping out a little bit in the risk spectrum to bonds, you can potentially lock in income for a longer period of time, and in addition, have that potential for capital appreciation.
We've been talking about the auctions this week and how the U.S. Treasury Department is selling a greater amount of debt. Are you saying this is a good time to buy? That 4% on a 10-year yield, to lock that in, seems like a really nice opportunity.
The window for the bond market has been extended over the course of the summer. It is, of course, a setback in terms of that recovery that we were hoping to see throughout this year, but it does extend that window of opportunity from an entry point standpoint. One of the biggest challenges that investors are dealing with today is price. Where do you find something at a reasonable valuation? Now, I will fully concede that if we look at debt and deficits over the next decade plus, with deficits coming in at 5.5% to 7% on average, that is historically high. And we are going to deal with a yield problem over time. But I think given the economic backdrop in the near term, this is a pretty good entry point.
What does it sell right now to high net worth people about cash at a 5% yield? Are they comfortable with that, or they're saying, wait a minute, why can't we buy more Apple?
You see that clients are comfortable with it because, again, you haven't had that type of yield in so long. But I think getting back to your question about the 60-40 and how we broaden out that allocation, we're also seeing that people realize this is not a market for easy money. It's not just that you're going to experience beta that's going to go up. So people have to be a little bit more discerning in how they're investing, not only around the world, but in terms of types of vehicles, thinking about alternatives to enhance different outcomes for income, diversification, capital appreciation. So I think that people are really sharpening their pencils.
So you're saying this time active management wins. Into 2024, active management will beat index.
Take a look at profits, take a look at companies, even within the same sectors or industries. You're seeing a lot of differentiation in terms of how management is handling higher prices, higher wages, more headwinds thrown at them. So certainly it is a time to pick and choose which managers and which management of companies are doing the right things in this environment.
Meera, thank you. It's good to see you. Meera Pandit there of JPMorgan Asset Management.
This is an important interview, without question, our interview of the day in fixed income and all that it means across equities, commodities, and foreign exchange. Rob Waldner is out of the vintage of Newtonian calculus. That would be engineering at top East Coast schools with a heritage back 200 years. He's Princeton civil engineering, and that is a rigor about statics and dynamics that he brings to fixed income right now. This is not statics in the fixed income market. What is the dynamic of all the algebra, the math of fixed income right now? What's the dynamic that you're focused on?
Well, Tom, you were talking about it earlier in this in the show, which is the news around disinflation and almost sort of seems like deflationary sort of vibes that we have out there. So we're getting U.S. CPI data on Thursday. We get Chinese data tonight. Chinese data CPI is likely to come in negative year on year. U.S., I think the Bloomberg consensus is we'll get a 0.2 on core and 0.2 on headline month on month. So the data is starting to come in as we've been anticipating, very disinflationary. And it looks like, certain areas like China and the trade data we got overnight feels more like deflationary. And I think that's what's going on in the bond market here is people are finally realizing or looking at that and thinking, hey, if I can get a 5.5% for an investment grade bond portfolio, and we are in a disinflationary environment where where growth is going to be, mediocre, that sounds pretty good, right? So that's where the buyers come from.
So there's a tug of war right now between disinflationary forces and additional treasury supply. You don't think that treasury supply wins out? You don't think it's as important as the disinflationary forces when it comes to what this bond market's going to do? Day
to day, the treasury supply can drive things, and I think you were talking about it earlier. That's probably part of what's revalued things last week, is looking forward to that supply. But we know that in any medium-term, month-type horizon, supply is not the driver. It's the macro forces that drive real yields.
So have you been buying this bond sell-off?
We are positive on duration. We've been looking at this treasury. If you want to talk about the treasury for a second, we think the 10-year has been in this 3.5% to 4% range. I'm actually getting a little more positive than that. So thinking about that here is a great buying opportunity because, one, as I said, you have a disinflationary environment with relatively moderate real growth. And so that in the medium term, that's quite good. And then if I start to think about the risk scenarios are that the Fed overstays its welcome here. We have several Fed members saying they think they need to hike again, even though we believe we're in a disinflationary environment. That could be quite negative for the growth outlook. That could create a dislocation, and that would be very positive for the treasury market.
So in other words, when we're talking about these auctions this week, are you basically saying, yes, let's go? I can't wait to load up on both 10-year and 30-year treasuries.
I think that, this is a great time to buy fixed income. And if you want to buy treasuries, if that's your asset of choice.
So who is coming in and joining you? Are you seeing more institutions who are doing the same thing that you are? Or is it still the international buyers, still the same buyer base, and that we're all just making a lot of noise over nothing?
Well, you have the same buyer base. The same international buyer base is still there. Fixed income flows have not turned incredibly positive yet, but we think that's likely to come.
Can we talk about the new floor in global fixed income? Now the BOJ is pulling back, the ECB has pulled back, the Federal Reserve has taken rates to 5.5%, and people think maybe they only come back to maybe 4, 3.5, something in between. What is the new floor for global fixed income? If you get into trouble, what do you rally down to, just in terms of yields? What are the limits of that rally? Because people don't think it's zero anymore. What is it?
Well, we'll have to see where that pans out, and it depends on what a recession looks like, how far we get down.
If you develop thoughts on that.
But we think that it's something in the range of sort of a more normalized yield curve would see, a more steep yield curve, and if short rates get down to 1, you're talking about 10 years at 2.25.
You think short rates will potentially come back down to 1?
In a recessionary type environment, yeah.
Interesting, because Lisa, the kind of pushback I've heard is that perhaps you come down to 3.5, 4, something like that. I think that was Mike Gapin's point over at Bank of America.
That essentially inflation would be stickier for longer, and that would keep the Fed at a higher level, that they weren't going to go back to the low rate kind of environment. And I just wonder how much this is really the poles of the debate right now, people who believe we're going back to the environment we were in before, and those who say this time really is different.
What are we going back
to? I would really point, we live in a nominal world. I think sometimes we get confused by this real and break-even stuff. We live in a nominal world. Nominal growth is coming down very, very quickly. So inflation's coming down, and growth is coming down. So, if you think going forward we're nominal growth somewhere in the 4.5 type of range, that's a tremendous environment for fixed income, right? And if nominal growth settles at something below that, then you could see rates come back down.
Rob, this was great. Thank you, sir. Rob
Thank
Waldner
you.
there of Invesco. Good to see you in person.
What we're going to do is dive in now with expertise at Bloomberg Intelligence. Long ago and far away, you did what you could to steal the research of Prudential Research and one Lee Klaskow. He was read worldwide and across this nation on boring stuff like trucking and railroads in this strange word, logistics. He's senior logistics analyst for Bloomberg Intelligence. Is a gift we have him today. I'm going to conflate in here the bankruptcy of Yellow with what we see in UPS. Given these events, can they raise rates? Can they raise and sustain revenues by raising rates?
Yeah, I mean, that's what UPS is going to have to do. And they do have pricing power because at the end of the day, there's really two main competitors. It's UPS, FedEx, obviously the U.S. Postal Service or some smaller players. But they have the ability to raise rates. And not only can they raise rates, but they're also going into markets that are more profitable for them. So they're going to the small and mid-sized shipper versus the big enterprise shipper. So they're kind of pivoting away from the Amazons of the world, if you will, and going, kind of down market because those customers tend to be more profitable, and they're going into more profitable verticals like healthcare, which tends to make more money for these.
You don't do buy, hold, sell, John, but to me, you wonder if this is like back up the truck and load the boat.
I'm not about to do a buy, hold, or sell on that name either.
You back up the brown truck and load the boat right here.
Can we bring in the volume story into the conversation and just talk to me about what's happening domestically in America? Because we're hearing from some domestic-focused airlines, for instance, JetBlue, Southwest, mentioning that maybe things aren't as great as people are saying. What are we learning about the domestic U.S. economy from this company?
Well, we've been in a freight recession for quite some time, and that's really driven because everything's being normalized, right? We're recalibrating back to where we used to be before the pandemic. So freight is declining. So what we're seeing is what we view as kind of like the bottom of that, and there's been a lot of destocking by retailers, and we're pretty optimistic that you're going to see some sort of seasonal uptick into the fourth quarter. We're not calling a huge peak season, but last year there was no peak. We think there's like maybe a slight speed bump of a peak this year. And what's that telling us is that the consumer is still resilient, and things should look better for a UPS or a FedEx into 2024 on a volume standpoint. You have that plus pricing, you have that plus productivity improvements from tech. It's hopefully going to offset some of the increase that they got in cost from that new labor agreement with the Teamsters.
So how significant was that? I mean, that was really my question. Is that a smokescreen, this whole agreement with the Teamsters to cover some real fundamental weakness that they're facing or competition? Or is this truly going to create a challenge to their profits going forward in a more material way?
It's definitely going to challenge things, but what I would say is that in the second quarter, the second quarter, that's a has-been quarter, they did a fantastic job. I mean, they beat by 4 cents in EPS, and it was all on margins. It wasn't on pricing. It wasn't on volumes. They actually disappointed. So they disappointed on the top line, and they surprised on the upside on the EPS, and that was real on margins. Their domestic business was, it was about 130 basis points better than expectations, and it was only 30 basis points less than what people were thinking.
If they can absorb it, what's the message to other logistics companies, to other trucking, shipping, flying companies that are also facing some organized complaints about the lack of wage growth, the lack of pass-through of some of their profits to the employees?
Yeah, at the end of the day, labor is increasing, and we're not going back to a 2017, 2018, 2019 level. So, if you're a truckload carrier, you had to increase what you paid your drivers. Rates have gone down considerably, and so what that's doing is forcing a lot of smaller companies out of the market, and that will firm up rates and bring rates back up. And so the Knight-Swifts of the world will have much better margins in the coming quarters. So
with higher prices.
With higher prices. Right now, the truckload market is terrible. Like the spot market is pretty much bottoming. We should probably start seeing increase in spot rates into fourth quarter, and contract rates are down by low double digits. And we expect that to kind of invert positively in 2024 to see maybe mid-single digit truckload rate increases on the contractual side.
If there was high single digit, even double digit revenue growth, and that reverts back to mid-single digit, low single digit revenue growth, the slog of logistics, if you will, can they sustain a given margin down the income statement?
Really depends on what subsegment of the market you're talking about. The less than truckload market where Yellow filed bankruptcy, that's a very consolidated market. So they have pricing power. FedEx, UPS, they have pricing power. Railroads, they have pricing power. Truckload carriers, not so much because it's extremely fragmented. So it really depends on what market you're in, whether or not you have the pricing power and whether or not you can push those higher costs onto your consumers.
Lee, this was great. It's good to see you. Come back soon.
I will.
Lee
Thanks.
Klaskow there of Bloomberg Intelligence. Thank you very much.
Lisa Abramowicz and Tom Keene. Thrilled that David Rubenstein could join us this morning. This is perfectly timed because Novogratz has been the piñata of Bitcoin when it goes down. It's been the genius of Bitcoin when it goes up. And all of a sudden, Larry showed up at the door to say, hey, big, respectable firms can prosecute and do Bitcoin. Link Lawrence Fink of BlackRock to Mike Novogratz.
Well, what's happened is people, as you suggest, make fun of Bitcoin and other cryptocurrencies. But now the establishment, Larry Fink at BlackRock, is now saying they're going to have an ETF, if approved by the government, in Bitcoin. So you're saying, wait a second, if the mighty BlackRock is willing to have an ETF in Bitcoin, maybe Bitcoin's going to be around for a while.
Lisa wants to jump in here, but I'm going to cut to the news moment. Is Carlyle announcing this morning a Bitcoin advocacy?
No, I don't think so. But there's no doubt that Bitcoin is something that I wish I had bought it at $100 a Bitcoin when Mike Novogratz started buying it. It's now at $29,000. So he's made a lot of money. And a lot of people who bought it at the $100 or less are feeling pretty good. Now, it went up as high as $61,000, I think. Even down to $31,000 or even $29,000 now is still pretty good profit if you bought it at $100.
We all wish we would have bought it at 100 and to ride it up. It's one thing for BlackRock to come up with an ETF because they believe in the proposition of Bitcoin. It's another because they see a profitability proposition where they can, basically take advantage of the interests other people have. I mean, isn't that more of what this is? That basically Wall Street is saying if there is a market for it and we can viably make one for them and make some money, why not?
Well, remember, Wall Street is in business to make money, and this is something they can probably make money of. You have to remember, the United States government has been somewhat skeptical of it. I think Democrats in the Congress, and particularly the people regulating the SEC, are skeptical of Bitcoin and other cryptocurrencies. But outside the United States, there's a lot of interest in it. I think FTX really hurt when it went bankrupt, and it hurt the crypto industry. But a lot of people around the world want to be able to trade in a currency that their government can't know what they have, and they want to be able to move it around, rightly or wrongly. And so I don't think Bitcoin is going away. And I think the Republicans on Capitol Hill have been pretty supportive of it.
There's a difference between having a seamless cross-currency payment, basically saying that instead of going to Western Union, I can go and just transfer something in Bitcoin if it has a stable enough price. That's one proposition. But the proposition of Bitcoin as a store of value that could kind of be bid up the way that gold or silver could seems to have been parked with the advent of yield suddenly that you can get for actual money. I mean, isn't that sort of the feeling that you're getting?
Well, there's no doubt that when interest rates are as high as they are, you don't need to have gold or other kinds of things to get you some solid return, because when you get 5% on treasuries, but eventually 5% will be coming down at some point. I don't think Bitcoin or cryptocurrencies that are the better ones, the better known ones, Bitcoin and so a number of others, are going to go away. There's enormous interest around the world in being able to have something you can transfer without the government knowing about it and keep it private. And you can say people shouldn't do that, but that's not going to stop people from doing it.
Mr. Novogratz on Mr. Gensler, what did he say about the efforts of our chairman of the Securities and Exchange Commission?
Well, Gary Gensler, who's the chairman of the SEC, is not a big fan of cryptocurrencies. I think that's fair to say. But he lost a major case recently in court where he was trying to argue that one of the cryptocurrencies, Ripple, was a security, and he lost that case. So I think the SEC has not been able to convince at least the government yet, or at least the courts, that cryptocurrency is such a dangerous thing. And I remember a lot of people in the government now are thinking that Gary Gensler won't be the chairman of the SEC forever.
That's where I wanted to go. I mean, these guys just wait him out, right?
I think that's a strategy. It's very popular in Washington, waiting out regulators you don't like.
And that seems to be something that has worked given some of the turnover that we've seen. I want to shift gears a little bit because we've been talking all week about banks losing talent to your world, to private equity, and to the sphere of private debt and equity that has continued to take more and more market share. Have you seen that accelerate recently as people really take a look at what they can earn and the potential opportunities in your world?
There's no doubt that some of the large investment banks, like Goldman Sachs and others, but not just Goldman Sachs, have people leaving. But that's actually relatively normal. People leave all these firms all the time. After people typically retire from Goldman in their early 50s, whereas regular kind of job, you might retire in your 60s. So I don't think it's that unusual right now. And I think Goldman's obviously got a deep bench. I think it's in pretty good shape. But there's no doubt that people think that in private equity, if you do well, you can make more money than you can in investment banking. That's generally been accepted for the last 10, 20, 30 years or so.
Do you think that that's going to get pressured at all as there is more competition and frankly in the higher yield environment, and if there is some sort of default cycle and a little bit of stress?
Well, remember, in private equity, it's harder to do private equity deals typically today because interest rates are higher, harder to borrow and so forth. But that gives people more opportunities to buy things in the distressed debt area. So there's always people who want to buy things at some kind of value chain proposition. And right now, there's a lot of view that you can buy things relatively cheaply, probably in the near future, in distressed real estate or other kinds of areas. So I don't think all of a sudden people that want to be investors are going to say there's no opportunity.
In what you're doing at Carlyle with your team, is there malinvestment in AI right now? Is there a frenzy going on where dumb decisions are being made?
Well, I don't want to speak for Carlyle. I would just say generally, AI has caught attention and people are putting money into it. Whether you're going to make a good return on that money, I don't know. There's a conventional view that the best way to invest in AI is investing in the large companies like Google, Microsoft, and so forth. Other people say you should go find the next startup of OpenAI. I don't really know which is going to prevail, but there's no doubt that people are putting money into AI, and they will for some time.
I want to just pick up on one thing that you said, that in the near future, there's going to be a good amount of distress, particularly in some real estate areas. Where are you talking about in particular?
Well, I don't think it's a secret that in the commercial real estate office market in major cities, New York, San Francisco, among others, people are not coming into offices, and therefore employers are thinking, I don't need as much office space as I once thought I did. And also, because interest rates are higher, the value of buildings goes down. There's an inverse relationship. So if interest rates are high and the value of real estate goes down and people don't need as much real estate as they did before, and then they renew their leases, they're going to take less space, it's probably going to mean the value of these buildings is going to come down.
How concerned are you about New York City?
Well, people have been concerned about New York City for the last 200 years or so. For 200 years, people always say New York City is going to fall apart, and for 200 years it survived. So I got a lot of things I'm worried about, but New York City is not number one.
David, thank you so much. David Rubenstein with us here. Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.